We've talked about private equity secondaries in a couple previous videos. We've talked about it in the video about direct investing, fund investing, and co-investing. And we've talked about it in the video of the Jcurve. Since then, we've received a few inquiries for further clarification. And so in this video, we're going to go into a little more detail on private equity secondaries. Today, we're going to talk about three things. First, we're going to go through the definition of primary versus secondary. Next, we're going to talk about private equity fund secondary transactions. And third, we're going to talk about private equity direct secondary transactions. So first, what is primary and what is secondary? Let's look at a private company and the process of becoming public. When a private company wants to become public, it does an initial public offering, known as an IPO, and it trades its shares for the first time from being shares of a company to shares of investors. And so that is the primary market. Once the shares are trading on a stock exchange, they're traded back and forth between investors, and that's the secondary market. Now let's look at a private equity fund secondary transaction. And to do so, we're going to build upon our last video of the Jcurve, where we said that through a private equity secondary transaction, you can mitigate the Jcurve. A private equity fund has four main things that it does. It finds companies, buys companies, creates value in companies, and sells companies. When a private equity fund finds companies and buys companies, that's the negative portion of the Jcurve. When it creates value and sells companies, well, that's the positive portion of the Jcurve. And so if a buyer of a secondary transaction can buy into the private equity fund after the negative portion of the Jcurve, well, then it's mitigating the Jcurve by buying in the private equity fund after the negative part of the J. But how does that actually happen? Well, an investor can buy into a private equity fund as long as it has a matching seller. And so some investors that are in private equity funds can't wait till the entire term of the private equity fund to end because they need cash for some reason. And so if a buyer of a private equity secondary can find a seller of a private equity secondary, then you have a transaction and that buyer has successfully mitigated the Jcurve. Now let's look at a private equity direct secondary transaction. And by direct, we're talking about investing directly into a private company, and the secondary portion means we're buying it from another investor. To explain this, let's look at BlueCat Networks. BlueCat Networks is a growing technology company that was looking for capital in 2009. In 2009, they wanted to add more people, they needed money for product development, and also needed some extra working capital. At that time, Northleaf Capital Partners invested in BlueCat Networks. 7 years later, BlueCat was still growing. But at that time, another one of its investors, a private equity fund, wanted to sell its stake in BlueCat Networks. The reason the private equity fund wanted to sell its stake was because the private equity fund needed to return capital to its shareholders because the term on that private equity fund was coming to an end. And so Northleaf Capital Partners, which already had a relationship with that private equity fund, was able to increase its stake in BlueCat Networks by purchasing the stake of that private equity fund in BlueCat Networks. This is a private equity direct secondary transaction. Let's recap. We've talked about the primary versus the secondary market. We've talked about private equity fund secondary transactions, and we've talked about private equity direct secondary transactions. I really hope this clarified any questions you had on private equity secondaries. If you have any further questions, please share in the comments below.